This is Nightly Business Report with Tyler Matheson and Sue Herrera.
The big bounce back, a strong start to the month of May with the major averages rising more than 1%. Our market monitor has some picks for this market.
Hitting the gas, why bigger is better at the nation's auto dealerships.
Playing to win, 6 ways to win a bidding war in this hot housing market. All that and more tonight on Nightly Business Report for Friday, the 1st of May.
Good evening, everyone, and welcome. Stocks start the month of May in rally mode, shaking off a rocky end to April. Gains in Apple helped lift the market, along with a rise in consumer sentiment and strong auto sales. And we'll have more on that story in just a moment. But it wasn't all positive. Dow component Chevron saw shares fall after posting a sharp drop in profits, and construction spending also declined last month. But the bulls were firmly in control, and by the close, the Dow Jones Industrial Average gained 183 points to 18,024. The Nasdaq rose 64, and the S&P 500 tacked on 22 points. Even with today's gains, the major averages are in the red for the week, with the Nasdaq off the most, down almost 2%. And later in the program, our Market Monitor guest will tell us what's next for stocks and tell us which names he's recommending right now.
Well, Sue, as we just reported, Detroit's Big Three all came out with strong sales for April, helping to drive today's generally positive sentiment on Wall Street. Chrysler and General Motors saw April sales up about 6%. Ford's up about 5%. Phil LeBeau explains why trucks are key to the automakers.
Pardon the play on words, but bigger was big at auto dealerships last month. Trucks, SUVs, crossovers, almost anything with a little more space was in greater demand than cars last month. For example, GM had its best month ever moving crossover utility vehicles. Meanwhile, Ford's new F-Series pickup helped the automaker boost April sales. With gas still selling at modest prices, buyers continue to pass on electric models. Chevy Volt sales dropped 45% as the company prepares for a new Volt later this year. Meanwhile, demand for the Nissan Leaf also lagged. And in a sign the auto market remains robust, the average amount paid for new vehicles at dealerships climbed slightly higher in April and now tops $32,000. Heading into the summer, automakers and dealers expect a busy season. That means there may not be many deals for those in the market for a new car or truck. Phil LeBeau, Nightly Business Report, Chicago.
Another sector, and one we don't often speak about, also had a breakout day. Rail car makers. And that group gained on tougher oil train safety rules announced today by regulators following numerous spills and explosions. Greenbrier, Trinity, American Railcar, and Wabtec all saw their shares climb by 6% or more. Morgan Brennan has more on the long-awaited regulations.
Nearly 2 years after a fiery crude train exploded in Quebec and killed 47 people, and 9 months after U.S. regulators first issued safety proposals, new rules were unveiled today, aiming to improve safety when it comes to transporting crude by rail. In a joint press conference with its Canadian counterpart, Transport Canada, the U.S. Department of Transportation outlined new requirements for stronger tank cars.
Now, we are, in fact, putting in place a new standard for building tank cars. They'll be required to have thicker, stronger shells and other safety features. Existing tank cars used on high-hazard flammable trains today will either have to be retrofitted to meet the new standards we've set, or they'll need to be phased out of service. Canada is taking the exact same steps.
As crude by rail shipments have surged in recent years, so too have the number of accidents. Since 2013, more than 24 crude trains have derailed. Those accidents represent just a tiny fraction of the trains moving each year, but they've been dramatic, stirring public outcry. As part of the new rules, older tank cars will be phased off the tracks in 3 years, and newer ones must be retrofitted or replaced within 5. But the biggest change is an operational requirement that goes into effect in 2021. Tank cars must be equipped with a new braking system, which falls on the owners, energy companies, or manufacturers who lease them out. If cars don't have those brakes, railroads have to either haul oil trains that are smaller than 70 cars or run bigger ones at 30 miles per hour. The Association of American Railroads argues that requirement could cause more gridlock on the tracks, impacting capacity.
could be as much as a 30% impact on our capacity. So this is a regulation that is not grounded in science, and I don't think that, unfortunately, the department thought through what all of the consequences would be.
The trade groups for the petroleum and rail equipment industries also expressed disappointment about these breaks. That aside, the overall reaction to the rules was enthusiasm, in part because they finally provide some clarity. Investors liked them as well, sending shares of tank car manufacturers like Greenbrier, Trinity Industries, and American Railcard soaring. For Nightly Business Report, I'm Morgan Brennan.
Despite today's rally in the stock market, two high-profile sectors have started to stumble, and investors are now wondering if it's a short-term concern or the start of something bigger. Josh Lipton looks at the recent drop in part of the tech market. But first, Julia Boorstin reports on the sharp declines that have befallen the social media stocks.
LinkedIn shares plummeting more than 20% on concerns about weak guidance for the second quarter and the rest of the year. It's LinkedIn's worst day ever as a public company. And it's one of three social media companies whose stocks have lost nearly a quarter of their value this week after reporting a disappointing financial outlook. Thursday, Yelp tanked more than 23% on disappointing guidance, while Wednesday, Twitter shares declined to their lowest level since January as it warned that some ad products won't generate revenue as quickly as hoped.
There's a common thread among these companies in terms of the advertising challenges that they're facing.
These stock declines are sparking talk of a market top and raising questions of what this could mean for social companies in the IPO pipeline. Investors, ironically, are having this conversation on Twitter. VC Chief Hua Chen pointing to the three stock declines, asking on Twitter, is this the start of a market correction in tech? Investor and Google Analytics expert Adam Singer tweeted, Twitter imploded, Secret shut down, Yelp crashed, and now LinkedIn got fired. Maybe VCs will stop funding every dumb social app now. Facebook draws none of these concerns. With 1.44 billion users, it dwarfs all other social companies. And its portfolio of apps, including WhatsApp and Messenger, are growing users fast, while it improves results with new products like video ads.
Facebook is exempt from what these other companies are facing because of both their scale and the fact that they're still growing the amount of time that users are spending on the site every single day.
But even Facebook shares are down over the past week and a half since it reported results that were impacted by foreign exchange rates. Still, with such massive scale, it may benefit from the other companies' social ad struggles. For Nightly Business Report, I'm Julia Boorstin in Los Angeles.
It's not just social media stocks taking a hit. The air is also coming out of some recent high-profile tech IPOs, and the declines are startling. This year alone, GoPro is down some 20%. Lending Club, a peer-to-peer lender, is off 30% despite being in a hot sector. Even Box, which went public to big fanfare, has seen its shares drop sharply from their highs. All three companies went public within just the past 12 months. Many attribute the declines to lofty valuations relative to their ability to generate profits. And the trend hasn't gone unnoticed by venture capitalists, who are always looking to invest in what they hope will be the next big thing. Venki Ganesan of Menlo Ventures says it's good to see these corrections. Many of these stocks carried nosebleed valuations, he says, and needed to come back to earth. There could also be knock-on effects. Investors use comps from public markets to justify valuations in private markets. So a cooling in the public markets should mean, Ganesan says, a cooling in the private markets as well. For Nightly Business Report, I'm Josh Lipton in San Francisco.
And now to our market monitor, who is bullish long-term on the market, but says stocks could face some short-term hiccups. He is Sarat Sethi, Managing Director at Douglas C. Lane, an investment advisory firm with about $4.5 billion under management. Good to see you, Sarat. Welcome back.
Thank you.
Let's start, first of all, with the tech sector, which we've just been profiling in the pieces by Julia and also by Josh. Is it simply a function of high valuations and the air coming out of these stocks, or are we seeing companies that are increasingly becoming less relevant?
I think it's probably the former. What we see in technologies, you really have to break it up into the momentum stocks. Those are the social media stocks with a lot of fast money following those, and then the old school tech stocks, companies like Microsoft, Cisco, that have actually done well. And if you saw Microsoft's earnings, the stock's up 15%. So I think broadly taken, you have to really bifurcate the technology sector. We are investing more in companies that are going to grow longer term, but have real earnings and not just eyeballs, kind of similar to what we had, many years ago.
Sarat, do you think the next 3 years in U.S. stocks are going to be as good relatively as the past 3?
Well, I think if you look at the last 3, we've had over 50%. I think, to go back to reversion of the mean, we expect probably high single-digit returns for the next 3 years, but that's going to be a bumpy road. We haven't really had that 10% correction in 3 years. But I think if you come out of this 3 years from now and we're up 25 to 30% in total, that would be a good number to look forward to.
You've given us some stock picks to talk about tonight, and one of them is Alcoa. Why do you like it?
So Alcoa is an interesting stock. They've really transformed their company. It used to be a pure play alumina stock, but now what they've done is they're focused more on value-added products, especially products that go into cars like the Ford F-150, and they have products that go into airlines. Those are higher margin, higher value products that there's margins and growth are much better than being in the pure commodity play.
The second choice is Nordstrom. Why?
So as we look, and oil has come down and kind of been below the $100 range, the consumer is now in a better stage. They're paying off their debt. The consumer also is getting higher wages. Employment is improving. Nordstrom's, we think, is the focus right there because they're focused on the high-end consumer. And what we like about them are a couple of things. One is it's omni-channel. So it's not just going to the store, but it's ordering online. Whether you do online, offline, they're there. Secondly, Nordstrom's about to sell off their credit card business, which could probably, we think, raise about a couple $2 billion, which they can use to reinvest back in the business and or buy shares.
Delphi kind of rounds out the list for you tonight.
Right. Going back to the consumer theme, we want companies that are going to benefit as the consumer spends more money. Delphi is increasing its digital content, its share in all auto companies, not just here in the U.S., but globally. And through this is a good way to play the consumer, but also Delphi as they increase top-line gross margins and really grow their cash flow.
All right, some very interesting picks. Thanks, Sarat. Have a great weekend.
You too.
Sarat Sethi with Douglas C. Lane.
And still ahead, why this weekend's Berkshire Hathaway shareholder meeting may be more memorable than one's past.
Tesla's Elon Musk is hoping to jolt the electricity market with the company's latest product. The firm is expanding into batteries for the home with a new suite of energy products, taking aim at the utility companies. The battery, called Powerwall, is made up of solar panel-powered batteries connected to a local power grid to help the world wean itself off of oil and gas.
Berkshire Hathaway reported a 20% rise in operating income for the first quarter, and revenue rose to more than $48 billion. The results start the Berkshire Hathaway's annual shareholder hoedown out there in Omaha, which gets into full swing tomorrow. This get-together could be particularly memorable because it marks Buffett's 50th year at the helm of the company. Becky Quick is out there with the Cornhuskers in Omaha.
I'm here on the floor of the Convention Center in Omaha, where 40,000 Berkshire faithful are expected to convene tomorrow. That's Saturday. This is an annual event that's been happening for 50 years here. This time it's a little different. This is the first time that the exhibit floor has ever opened on a Friday, the day before Berkshire's annual meeting. It's happening this year because it gives the shareholders who are here a little bit of extra time to check out all the booths. There are a lot of booths here. Many of them are for Berkshire companies like Dairy Queen, which is right behind us. Somebody just handed me a dilly bar. You've also got, check this out behind me, the Geico. Yeah, he's here too, the Geico Gecko, checking out all of these things. But it's not just those companies. It's also the companies that Berkshire owns a stake in or a big chunk of. In fact, Heinz is one of those companies. Heinz is a company that Berkshire owns a massive chunk in. And again, all of these companies have come here to set up these booths. Now, what happens tomorrow is Warren Buffett and Charlie Munger take the floor on a stage just behind that wall. They'll answer questions in front of a cast of about 30 or 40,000 people, answer questions that anything that somebody throws at them for about 6.5 hours. Some of the big questions that are expected this year will include everything from what's happening in the economy to what the Federal Reserve will do next, to even things like what's been happening with specific Berkshire units. Burlington Northern Santa Fe was called out in the annual shareholders letter that Warren Buffett wrote earlier this year for disappointing its customers. We'll hear more about that tomorrow. Also probably be hearing about Clayton Homes, which is set up just behind me back here. Some of the being accused of predatory lending practices, and I'm sure we'll hear about that tomorrow too. For Nightly Business Report, I'm Becky Quick in Omaha, Nebraska.
And on Monday, we will have extensive coverage of that Berkshire Hathaway shareholder meeting.
Charter Communications posted a wider than expected loss, and that's where we begin tonight's market focus. Revenue at the cable operator grew less than expected in March, and also costs from that failed merger between Comcast and Time Warner Cable hurt results, since it involved assets that Charter was planning to buy. Shares were up a fraction to $187.46. Sales of prescription drugs helped CVS post results that topped Wall Street expectations, and that offset the impact of the company's decision to stop selling tobacco. But its current quarter outlook fell below forecasts. Still, the stock was up more than 1% to $100.46.
It was a busy day for activist investors. Corvex Capital has taken a large stake in Yum Brands, this according to reports. Also, Dan Loeb's Third Point took new positions in Yum and Devon Energy, this according to a letter sent to investors. Devon rose a fraction to $68.61. Yum Brands popped almost 7% to $91.90. And a federal judge has ordered American Express to let merchants steer customers to other forms of plastic payments. Now, Amex can't stop restaurants and stores from offering discounts or other incentives for using lower fee cards. The payments company will appeal the decision, saying it'll hurt competition. Shares were up slightly to $77.68.
As we head into this spring weekend, house hunters will be on the prowl. And while we're still in the early spring of the housing recovery, the market right now is very hot and very competitive. Diana Olick has some advice if you're looking to bid and to buy.
Very tight supply in housing markets across the nation is leading to bidding wars. In fact, 1/3 of all U.S. properties sold in March went at or above asking price. So how do you emerge the winner in a bidding battle? Prepare your finances and carry cash. Get pre-approved for a loan now. Home sellers are leery of loans that might not be set in stone. If you can, bring cash to the table so that if the appraisal comes in low, you can cover the difference. Offer fast and strong. Be the first offer and don't insult. Nothing turns a seller off more than someone undervaluing their prized possession. Come in either at or just slightly below asking so they know you're serious. Add an escalation clause. This is the amount of money the buyer agrees to increase the offer if there are other bids. So let's say the purchase price of the home is $400,000, but you expect it could go as high as $450,000. Put in an escalation clause saying you're willing to go as high as $460,000, but make sure the clause says the seller can only take a winning bid up to a level just above competing offers. Get a pre-inspection. Do the inspection before submitting an offer. Yes, it will cost you a few $100s, but sellers hate inspection contingencies on a contract. Show the love. If you love the house, then let the seller know it, either directly or through your real estate agent. Don't be afraid to write a letter, send a picture of your kids, and be specific. Be smart, not sappy. Research the market. Look at comparable homes that just sold. Visit the local school. Have coffee at the closest Starbucks and chat with the neighbors. Then don't let your emotions steal your wallet. Whatever house you're looking at, it's not the only house you could ever be happy in. For Nightly Business Report, I'm Diana Olick in Washington.
And for more tips on how to win a home bidding war, head to our website at nbr.com. Coming up, meet the man who hopes the odds are in his favor in America's most famous horse race.
what to watch next week. Tuesday, Dow component Disney reports earnings. On Wednesday, we will hear from the Federal Reserve Chair, Janet Yellen. Friday is Jobs Day, and that's when the government releases its employment report for April. That's what's on a busy agenda for next week.
As you know, it's the start of May and decision day for many high school seniors who must decide which college they will attend. But earlier this week, thousands of other students were left in the lurch when Corinthian Colleges shut its doors. It was one of the biggest shutdowns in the history of higher education in the U.S., and it's offering a cautionary tale, not just for students, but also for investors. Sharon Everson has more.
Students and their families are still in shock after Corinthian College, one of the nation's largest for-profit colleges, abruptly closed its doors.
You would think that they'd want to help us out, especially to kind of clear their name, but evidently not.
In mid-April, the U.S. Department of Education hit Corinthian with a $30 million fine for misrepresenting job prospects. It also curtailed its access to federal student aid last summer, a major financial blow to what was once one of the biggest for-profit college corporations in the United States. Corinthian's closure this week shut out 16,000 students in 6 states, but its impact may not end there.
After this past quarter, it's just a reminder that we're not out of the woods yet.
Ongoing federal and state investigations of other for-profit colleges and universities could impact many more students and investors.
I certainly think that other for-profit schools should be on the lookout for what might be coming down the pike and take steps appropriately. There are more than 24 state attorneys general, for instance, that are investigating for-profit colleges, many of them for issues like fraud and misrepresentation.
In July, new rules from the Obama administration will go into effect to create greater accountability and transparency. When comparing a typical graduate's annual loan payment to their annual salary, for-profit colleges that receive a failing grade will be ineligible for funding from federal student aid programs. At the same time as regulatory pressures increase, for-profit colleges have seen declining enrollments. About 1.3 million students were enrolled at a for-profit college last fall, according to the National Student Clearinghouse Research Center, a nearly 10% decline from the previous year. Students at for-profit colleges represent only 13% of the nation's college students, but receive about 30% of total federal student aid dollars, and account for nearly half of all loan defaults, according to the Department of Education. Other for-profit colleges with weakened balance sheets and significantly depressed capital are coming under scrutiny.
The two that come to mind for me are ITT Tech and Education Management Corporation. Neither of those schools have been subject to the delay that Corinthian was subject to in terms of drawing down federal student aid. If that was to happen, then I think you could see a similar chain of events, although I think it's still too early to tell.
Tarkin says even for those for-profit colleges that are financially stable, new enrollment is under pressure. Also under pressure, Corinthian's thousands of displaced students who may see few alternatives other than attending another troubled for-profit college. For Nightly Business Report, I'm Sharon Epperson.
This first Saturday in May is shaping up to possibly be the biggest sports day ever for television in the United States. The lineup includes the Mayweather-Pacquiao boxing match, the Kentucky Derby, hockey and basketball playoff games, the NFL draft concludes, and the baseball rivalry, Yankees versus Red Sox. According to a Nielsen poll, 52% of adults plan to watch at least one of those events. That's about 120 million people, and that's more than the number who watched the Super Bowl. And it's estimated that $200 million, by the way, will be wagered on both that boxing match and the Derby combined.
And tomorrow, one man will have 3 horses competing in the 141st run for the Roses, including the early favorite, American Pharoah. Dominic Chu is at Churchill Downs in Louisville, Kentucky, with his story and his chase for the crown.
Outperforming the stock market over time is tough, but it's even tougher to outperform in the high-stakes world of horse racing. One family has managed to do just that. Meet Ahmed.
It's race time!
Patriarch of the Zayat family and founder of the stables that bear that same family name. His horses have had runner-up finishes in the Kentucky Derby 3 times in the past 6 years. This year could be different.
It's the first time I'm ever in the Derby I'm allowing myself to daydream, because I know the disappointments and the peaks and valleys and the letdown. But somehow this horse particularly American Pharoah, is giving me this confidence, not arrogancy, confident that I'm the one, that I'll do it for you.
That horse is American Pharoah, the favorite to win tomorrow's Derby. Zayat also has 2 other horses running in the field of 20, Mr. Z and El Kabir. The man running Zayat's racing operations is his son, Justin.
Perfect. We're all yours now.
A 23-year-old student at NYU, he's been involved with Zayat's stable since he was a child.
My dream is to win the Kentucky Derby. That's my dream, you know. We've been here before. It's been a lot of fun. We know the adrenaline rush. I've done the Derby walk. It's so exciting doing it. It's an honor being back, but I want to win that Kentucky Derby. I dream about those roses, and I want them so badly.
All those dreams could be realized tomorrow night at 6:24 p.m. Eastern Time when those 20 thoroughbreds charge out of the gate with 3 Zayat horses having the chance to win America's greatest race. For Nightly Business Report, I'm Dominic Chu, Louisville, Kentucky.
I would be so nervous.
I would be so nervous too. Boy.
It's a fantastic race, and I can't wait to see it. But I might have blinders on.
Yeah, and boy,
like
are those horses beautiful. Man, are they
gorgeous.
pretty.
All right, that does it for Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great weekend, everybody. We'll hope to see you right back here Monday evening.